I recently met with a retiree who has done an amazing job saving in his 401k plan and his wife as well. She also had assets that she had rolled over from her employer plan to an IRA. And between the two of them, though, they were fine just living off of Social Security income. Now, while they've done an amazing job saving all this money, something's going to change at age 73 for the two of them that's going to cause them to have to start taking this money. For those of you that are watching and are familiar with required minimum distributions, you know that an RMD is due either at the age of 73 or 75 if you have dollars in a pre-tax account. And for the fortunate ones out there who have oversaved into these pre-tax accounts, in other words, they have more than they'll necessarily need come time to have to take out the RMD, an RMD could present a problem when it comes to your tax plan. Now, while they may not have the issue of running out of money, paying more in tax than they otherwise would have to could be what they're facing, and leaving to a surviving spouse and also to their kids could be an issue as well. If we've not met yet, my name is Danny Sinowitz. I'm a CFP professional from Hyperion Financial. Check out the quiz in the description below if you would like to have a better picture of how your tax plan is shaping up in retirement. And most importantly, don't forget to subscribe to the channel. You'll never miss an update in a video of some great tax planning tips and some things that you should be aware of come retirement. When I met with this couple, they seem to be in good financial shape, and by all standards, they really are. They have no debt. Their cash flow is plenty sufficient with the Social Security coming in and expenses going out. They've done a great job with their insurance planning and their estate planning. And their investment plan is right on track with where they need to be. The one thing, though, that is going to be coming is the required minimum distribution, and that could throw a wrench in their tax planning. Here's why. The first problem that they're going to be facing is an income tax problem. Being that they are only living off of Social Security right now, they actually don't have any taxable income. Their Social Security income is the only income that they're bringing in. Therefore, their provisional income is so low that they actually don't owe anything. And if you're interested in learning more about how Social Security tax works, be sure to check out the end of the video because I'm going to link to a great video that'll show you how Social Security is currently taxed and what it will look like in the future. But being that they're not currently paying any tax on their Social Security income or any income otherwise, they're feeling pretty good about their current tax situation. That's going to change come the age of 73, though. Now, these retirees have done an awesome job. They saved over $1 million in pre tax accounts. But the problem that's coming is that Uncle Sam is coming for the required minimum distribution. And that required minimum distribution is going to be taxable. As you can see in the example here, they actually don't owe any tax because their provisional income is so low. The standard deduction wipe out any taxable amount of their Social Security. So really they're in a position where they don't have a federal tax liability, which is a great position to be in. However, as the required minimum distribution kicks in at age 73, it's going to generate about $64,000 of income. This income is going to be taxable, and it's going to generate taxable Social Security for them. Now, in this example, it's about 77% of their benefit is going to be taxable, but it could be as high as 85%. And the point is, it's a double whammy in that the RMD is taxable and the Social Security benefit will now become taxable. This takes their adjusted gross income from just $500 to over $115,000. After the standard deduction is taken into account, the couple now finds themselves in a position where over $80,000 of their income is taxable. And the problem with this is this just will continue to grow as the RMD continues to grow as well. So understanding that while they're in a good position now, this RMD is going to be coming down the road and could be in a position where it's going to continue to drive them into a higher tax bracket. However, the other problem that this can create is other stealth taxes that could exist. Now, these retirees live in the state of Pennsylvania, so they don't necessarily have a state tax issue, but if they do live in a state where state taxes are deducted from retirement income, IRA distributions, or even Social Security, they could find themselves with more of a state tax liability. So make sure that you understand that both the state and the federal tax rules, especially when it comes to your required minimum distribution. Now, we talked about how your required minimum distribution would create ordinary income, which when added to your Social Security benefits would increase your provisional income. In other words, your Social Security benefits can become taxable up to 85%. The other way it could affect you are what's known as IRMA surcharges. Now, we talked about this in prior videos as well, but IRMA surcharges apply to this couple's Medicare premiums. Now, they're in a position where this specific RMD did not push them up, but as you can see in this graph, If your required minimum distribution does put you over this amount, if your modified adjusted gross income goes $1 over this amount, 2 years later, you could be paying an increased Medicare premium on your Parts B and D. As a result, you want to make sure that your required minimum distribution is not pushing you beyond these brackets because, again, it's more dollars out of your pocket that's going to go into the Medicare system. The third concern is actually investment income and the taxable implications that those can have. Both capital gains and net investment income tax could be affected by a high required minimum distribution. And if you're not familiar with net investment income tax, we did a video on that I'm linking to right now. But when it comes to your net investment income tax, if you go over 200,000 as a single individual or 250,000 as a married filing jointly couple, what you could be running into is an additional 3.8% tax on the lesser of the modified adjusted gross income over those thresholds and the investment income that you're bringing in. Similarly, those capital gains brackets that we've talked about in prior videos can be very favorable, but a required minimum distribution could also increase ordinary income, thus pushing you into a higher capital gains bracket. That required minimum distribution can throw off other plans that you may have if you're in the 0% or even the 15% bracket, and it could push you higher in the event that your required minimum distribution is fairly high. But the required minimum distribution can also have other effects beyond just taxes. It can also have investment concerns. Required minimum distributions need to be taken every single year. Being that it's the case where if you do not take a required minimum distribution, you're subject to a penalty, generally it makes sense to take them. But if you have an IRA or a pre-tax account that's invested, that is subject to market risk and could lose money, if that account is down and you take a required minimum distribution, you are essentially selling low. By selling low, you could be taking from an account that's already down, thus potentially accelerating the risk of running out of money. Depending on how much it's down and how much you're taking out, the effects could become much worse. So instead of having to take out a required minimum distribution every single year from an investment account that you don't have full control over, you want to make sure that you have a plan in place to cover that and make sure that you're not taking from an account that's either drastically down or even slightly down. Rather, you want to make sure that your investment plan is matching up with your tax plan and that you have a plan for your required minimum distribution and how to best take it. The next thing I think that you want to consider are the legacy concerns. And I think this is especially true for married couples when one spouse passes away and leaves it to their surviving spouse, when a surviving spouse leaves the dollars to the next of kin, or if a single individual leaves it to nearly anybody. Now, this wouldn't apply to a charity, and I'll cover that in a second. But why it's important to make sure that you have a plan for legacy is because the RMD isn't necessarily going to be going anywhere if you leave the money from spouse to spouse. Now, there is some nuance to this depending on the age of the surviving spouse that receives this, and depending on how they receive it, whether they receive it as their own IRA or an inherited IRA. But where this becomes important is that RMD is going to continue for the surviving spouse, being that it's a pre-tax account. Since it's a pre-tax account, in the case that I brought up earlier of the couple that I met with, the couple were right around the same age within a year of each other. As a result, the RMD is going to stay very similar to a surviving spouse of how much needs to be taken. Since that RMD does still need to be taken, the surviving spouse would have to take that in a given year. The difference would be that they're now subject to the single brackets as opposed to the married filing jointly brackets. And this applies across the board to those stealth taxes that we talked about. So understanding for the surviving spouse, this is going to create a situation in which it's likely going to result in more tax. So having a plan in place to make sure that a surviving spouse is not strapped with more tax is important to plan for. If you leave dollars to the next of kin, what becomes important then is the understanding that the stretch rule for the IRA is no longer in force. What is now in place is the 10-year inherited rule, in which case children or whoever you're leaving the dollars to have 10 years to liquidate this, assuming they're a non-spouse beneficiary. Depending on the income bracket that they're in, if they're in their peak earning years and they have 10 years to liquidate a pre-tax IRA, that could be more taxable income that they're going to be subject to, again, thus resulting in more tax and other stealth taxes along the way that they could have to pay. By having too large of an RMD or too large of a pre-tax account, you could be leaving dollars to Uncle Sam that you wouldn't be otherwise. The good news is that there are some ways to plan for this. What I'm linking to right now are two videos. The first one is what's known as a QCD, Qualified Charitable Distribution. And this video can show you how, if you are charitably inclined, it's a way to lower the taxable impact of an RMD. The second one is for those that I think have a little bit more time to plan ahead. And Roth conversion planning can be something that you can consider. Between these two videos, there are ways that you can lower an RMD and make sure that you're not leaving Uncle Sam any more than you have to be.